whole thing is a nothing burger. Let's just move on. It's stupid.
Well, so the markets are obviously reacting. Maybe we should talk about
They're not reacting to that. I think that they are.
You think it's an excuse? Like people wanted to trim positions, and this is a great excuse. Yeah.
Look. The week before when I started to trim, it was like, oh, how dare you? Blah blah blah. And I'm like, well, I don't know if the smartest people are selling. Maybe it makes sense to sell. So I started to trim, and I'm so glad that I did because it was, 10 days ahead or a week ahead of all of this craziness. Now look at what's happening in the markets today. People are going massively risk off. There are almost 500 stocks that are off 30 or 40% in the last 30 days.
Yeah.
But the stock market is still basically at all-time highs. So think of that for a second. So everybody that thinks that the stock market is doing poorly is wrong. It is doing exceptionally well. It's just that the 400 stocks that people in Silicon Valley really care about have been getting kicked in the teeth.
Yeah.
And the paper company and the specialty chemicals company have actually done reasonably well, which
Airplane
are nothing,
parts and
which is nothing that any of us have exposure to, or some of us don't have exposure to. So go ahead, Jason.
Chamath, can we then look at this as, hey, the era of we're going to give a lot of credit to companies for what's going to happen in the next 10 years,
10-year outcomes. Yeah,
the 10-year outcome that we saw. Rivian came up, and then many other stocks, and obviously crypto falls into this. This idea of giving people a decade of forward-looking credit maybe is going to come back to,
I think it's too early.
Let's weigh these and look at earnings, or maybe 2 years of credit.
No, I'm not going to say that because I think it's too early for us to sort of go and jump to these conclusions. Right now, we are in a moment. There have been 71 or 2 of these moments since 2009, where you have either a sector drawdown or a market drawdown. In this case, we're in the middle of a massive growth sector drawdown. Okay. The multiples on these companies are shrinking. Companies like Snowflake and
Peloton,
Cloudflare,
Zoom.
We're trading at 70 to 100 times revenue, and people are reevaluating whether those multiples are worth it, irrespective of the quality of the company, because those are very high quality companies. So we're just re-rating the risk right now. Okay. And it's not broad-based. The real problem is all these companies that I think raised a lot of money in private markets are now going to get stuck, because if the public markets have compressed multiples by 30 to 50%, they are the ultimate buyer. The idea that you can wait and then go public later may not stand to reason, especially if inflation really keeps these multiples in check. And so all these private businesses, and then all of the ones that sort of were planning IPOs in the next 12 to 18 months, are probably in a little bit more of a challenging spot than they were before.
And we're seeing a lot of, Chamath, is it not true that we're seeing a bunch of these SPAC deals and new issuances come out to market with converts attached to them? So rather than getting a straight valuation and common equity rolled, these deals are coming out where investors are saying, look, I'll value this thing, but I want to get paid a preferred return, and I want to have some seniority over the common. And so I can protect my investment to some degree. At least that's what I'm hearing from bankers, is kind of the rumbling in the SPAC and pipe market right now, is these kind of protective new types of equities that are coming out in order that the investors can kind of keep their mark on their private valuation rounds, but get the company out to public. But the public market is getting a better deal than just straight common equity.
Look, it's like bringing Pepto-Bismol to Mexico. If you're worried about an upset stomach, don't go to Mexico.
Okay, and we just lost 7% of the audience.
But you're saying you wouldn't invest in these converts for these kind of companies that need that.
We're focusing too much on the symptomology and not the root cause.
Right.
The minute that you're trying to wrap all these features around something, the nature of those kinds of features is that it's trying to subsidize what is otherwise not a clear, simple, buyable story at that price. So either change the price or change the company.
Yeah.
I will say one important point about what's going on. A lot of people have said this is a crash, and that term's been used a lot. But, because people that have only traded in markets and have a brief history, call it back to the 2000s, the last 3 major drawdowns have been the .com crash, then the financial crisis, and then the COVID crash. And all of them had true systemic risk that caused there's all these ripple effects and secondary effects. And Chamath, and for all you guys, it seems to me that this time what's going on is a devaluation that doesn't have systemic risk attached to it. If these
we had
multiples all
I don't know about
compress,
that.
We had this happen in 2018 because in 2018, it looked like there was going to be inflation. Powell, basically killed the market. He raised rates. And then it turned out he was completely wrong and China was okay and everything was fine. And then the market just completely violently snapped back. Again, this is what I'm saying, which is it's too early to tell whether this is just a short-term opportunity for people who have made a lot of money to de-risk. And again, Satya Nadella just sold 300 million of stock.
Wasn't it half his position? It was half of his position. Yeah, I mean that to me was significant.
Elon Musk sold 10 billion. I've sold almost I think $600 or $700 million worth of stuff this year. Like, this is what I think smart market participants do. You don't just wait and just try to market the last tick.
Sacks, you think there is systemic risk in here?
Yeah, I mean, look, first of all, what's going on here? I mean, Chamath is right that over the last 4 weeks, we've seen a 30 to 50% decline in these tech growth stocks. What is the reason for that? Interest rate expectations driven by inflation. For the first 6 months of the year, all you heard out of Washington, the administration, was this inflation was transitory. That story is basically that collapsed because now people can see that as persistent. They're now pricing in the risk of interest rate increases.
Oh, Sacks, you're breaking up.
He's done. He's toast.
He's done. He's toast.
Done.
I think the Fed just cut him off. He got cut off.
They cut him off.
He's probably still talking. He's on
a monologue right now. Henry Belcaster is cutting it right now.
Yeah, Henry Belcaster can TikTok him.
Well, whoever wrote this part of the speech that he has prepared for
crestfallen. They're super crestfallen. They're like, that was my best speech writing.
Whatever that guy's name is, I'm sure it's annotated, so he can go back to that point in his diatribe.
Right. Absolutely, yes. I mean, I think actually this is an AI version. This is like a deep fake of Sacks that we just played at this point for this monologue.
Reboot the Sacks.
We reboot the Sacks simulation, Uh-huh. Well, I mean, if we look at private markets, it's obvious that they were getting ahead of themselves. And I think to your point, Chamath, when we were talking before about what do private market companies do in this situation, well, I was advising them, if you can get at a high valuation and you can get clean terms, you take the money, sure, if it's from quality investors. But just make sure that you have enough runway to fill into this valuation if there is valuation compression, which is what there is now. So the idea that a private company with 20 million or 30 million in SaaS revenue was worth 50, 60, 70 times that's not the case right now in the public markets. And maybe it goes back down to 20 or 30, but you just have to have that runway to land the plane, correct?
Yeah. One way to think about that is it's less about, people often use that high multiple to refer to this year's numbers. Mm-hmm. But what the market is doing typically in those situations is they're saying the multiple in the future will be X. And so they're saying we project 5-10 years out this revenue, and I'm paying 1 to 5 times revenue, for 7 to 10 years out, or whatever the right kind of way that they're framing that up. But then the commentators on the market pricing come in and they say, hey, you guys are crazy. You're paying 100 times revenue. And the market isn't thinking about this year's revenue. They're thinking about revenue in years 7 through 10.
Yes, that giving credit, right? They're giving credit, right?
Yeah, and they can't do that now because interest rates, let's say interest rates climb to 3.5%. I can go make 3.5% by putting my money in for a 10-year bond. And now I can't and so I have to discount that future back from 10 years out. And now I'm only going to be able to value it in 5 years out. So now my revenue for 5 years out is like a little bit lower, and the multiple I'm going to give them a little bit lower. So the valuation today gets a little bit lower. And that's how these things kind of translate as a function of interest rates. It's a little bit harder to make a bet on a 10-year horizon because interest rates are no longer 0%. And so you have to kind of make a bet on a 5-year horizon or a 3-year horizon. And if interest rates are really high, you're betting on this year's numbers.